Hey traders, this is Blake Morrow. You are listening to the week ahead video for September 26, 2001. I've got a lot in store for you today. We've seen some market volatility coming back to the market, so that's exciting. There's a lot to actually unpack this week. But before I get started, I want to say thanks for spending your time with me and with us right now. And if you like these videos, make sure you give us a thumbs up. Make sure you subscribe to the channel down below. And also make sure you take advantage of ForexAnalytix and take advantage of the pricing. Here is the reason why. Come Monday, you guys will not be able to take a trial of ForexAnalytix. You won't be able to do it. You can't do it for $1 for 10 days. You know why? Because we are going to be offering our beginning of year discount. If you've been around long enough, you've been watching these videos long enough, you know right around the middle of September, we offer a start of the trading season offer. That's going to kick off on Monday. So be looking at the ForexAnalytix webpage for the discounted special rate. Only comes around once a year, around the middle of September. So it's coming on Monday. All right. So while you're doing that, while you're checking it out and while you're starting, make sure you jump into our chat rooms. Make sure you download the mobile app because that's included. Doesn't matter if you've got the light version or the premium version. Make sure you download the mobile app. Jump in our chat rooms if you're using the premium version. I'll see you there because I'm there all week during the days. So as long as I'm in front of the computer, I'm pretty much in that chat room. All right, let's talk about what happened this last week. So this last week was a really big week in the markets. We saw a lot of volatility. We had 5 central banks meet this last week, created some volatility. We got the FOMC. We kind of know the tape. We know the taper's coming. We know that the tapering is going to conclude the middle of next year. That means, more than the 10 billion a month that the market was expecting. And you know what? The market shook it off pretty well. But I want to show you a big development that towards the end of the week, bonds kind of sold off and rates started to rally. Now, this chart is really important to me for a few reasons. I don't necessarily trade bonds. I do from time to time, and actually, I actually enjoy trading them when I have. They just don't happen to be on my radar to trade right now. I'm more interested in other things that are happening in the currency market, but this chart matters. So let's look at this daily chart of the 10-year Treasury. This is the bonds, and you can think the yields are inverted of this, but really important chart. We've kind of rallied over summer. And we just kind of knocked our head up against, well, first of all, the 50% retracement of the August highs of 2020 to the lows of this year. We rallied back and retraced 50% of that retracement. So bonds are starting to sell off. We couldn't hold the 200-day moving average. We're rolling over and we're approaching the lows of basically 2021. We're not too far away. We're approaching the 78% retracement, which comes in at 131.26. Okay. Now, the reason why this is important is because if we start breaking down below the lows of 2021, we could very easily challenge levels that we haven't seen since 2019. Now you think these are levels in bonds pre-pandemic. You can see what happened during the COVID lockdown. We had a rally in bonds for safety reasons. Yields dropped. Now yields look like they may start to rally back. And if you listen to my one of my partners at ForexAnalytix and also one of my colleagues in the morning on the F.A.C.E webinar, Stelios Kontigoulis, he has mentioned this quite a bit over the course of the last year. He's like, look, stocks are going to stay elevated until yields start to rally. And once yields rally, that might be the end to the stock market rally. And what we've seen in stocks is we've seen stocks look like they are putting in lower lows. And we're yet to find out if we're going to put in a lower high, but I'll show you that chart in just a second. But the reason why this is all very important is because if you look at what's happening in the bond market, yields are starting to rally. Rates are going higher. That means that the market is starting to, come to the conclusion that things are normalizing, right? So once we start, trading at levels that we haven't seen since pre-pandemic, which would be, down towards 130 in the 10-year, that would suggest, and that would be obviously a breakdown of the support here, that would suggest that things are, the market's assuming things are going back to normal. Yields go up, stocks might actually come down a little bit. So let's take you over to the S&P. I got to get rid of this intraday chart that I've been, if you follow me via Twitter, you saw this Gartley pattern, if you will. All right, it's somewhere around there. Here's the 88% retracement of this move. But I want to show you how important this resistance is. I've been looking at the 4450 level as being pretty important resistance, like the last, Thursday and Friday of this last week. But I want to show you technically why it's so important. So if you have this big ascending wedge that we broke down, we've obviously rallied back and we, recovered. I have to admit, I'm actually pretty impressed. I shouldn't be, because the stock market has been in such a bullish trend over the course of the last couple, 3 years minus the pandemic move, right? But I mean, we've come off of a really strong uptrend. We've been rallying for the last year very strongly, and we finally broke that ascending wedge. Notice how we've made, and let me just grab this oval over here, and I'm just going to take it over here. Notice how we've made lower lows. So now if we make lower highs, that's going to be technically a shift in the stock market. We're not making higher highs and higher lows anymore. We'd be making lower lows, and if we peak somewhere around here, it would be lower highs. Now, let's think about this. Let's think it through a little bit. The reason why this level at 4460 was so important is because it is a 618 golden fib, if you will, Fibonacci retracement of the high to low of this last move. It's the 618 retracement. Now, the reason why you see that blue box there is because in our dedicated webinars for the ForexAnalytix community, I'd put that there because I thought we might be able to rally past that level into the underside of the wedge resistance. And if you've been listening to those webinars for the ForexAnalytix community, which, by the way, when you take advantage of the special offer, you can listen to those webinars that are only for ForexAnalytix traders. So I'll see you there. One of the things that I've been noting for the last, on Thursday and Friday of this last week is this bounce should expire or should find some really key resistance between the 4460 to 4485 level, which would be these previous highs right here, horizontal highs, underside of that trend line, and just above the 618. So I think this is like a resistance zone. Now, if you think about, the end of the week, we, closed near the highs, not too far off the highs. As long as we don't have any nasty headlines about Evergrande or, what's happening in China. Matter of fact, China could do a, reserve ratio requirement cut and a triple R cut. That might happen over the weekend. Stocks are probably going to gap up on Monday morning. Monday morning going to quote unquote turnaround Tuesday. You guys have heard us say that over the years and years and years. If we get a rally on Monday, we might find some resistance around the 4485, maybe 4500 level going into the beginning of the week. And I think that might be a pivotal area for stocks. Now, why does that matter to a currency trader? Because there are certain things I'm looking for in the currency market and certain things I've been watching very carefully. First and foremost, let me take you over to the Aussie dollar. And by the way, in a risk-off type of environment, the dollar tends to strengthen, but it's not just by the dollar. The dollar against certain currencies is going to act a little bit better. If you look at the Aussie dollar, it has actually performed poorly. Now, I was pretty impressed on the rally from the 71 cent level in the Aussie. If you guys have been listening here for the last few weeks, I thought it was pretty impressive. I always had hoped that we'd challenge the 70 cent level, maybe a little lower, and that's where I wanted to be long. This is a big 38% retracement down at 70.40 roughly of this entire move. The spike low here, this is post-COVID low to that rally. 38% retracement comes in right at 70.60. 70-40, right? 70-50. Let's just call it 70-50. You can see it right there. That if we challenge 70-50, that means we would make a brief new low. And let me square up that chart. Imagine this. Imagine we broke through these lows and we hit that 70-50, that resistance or that support zone. What I would be happy with is actually being a buyer down at 70-50. Now, I think that is a risk. Why do I say it's a risk? Look, we closed at the lows of the week or near the close of the lows of the week. That's not typical of the Aussie when the stock market has bounced back so aggressively. The Aussie has acted really poorly. Matter of fact, the Aussie stalled at the 38% retracement at 71.90 following the Fed, following the FOMC, and I actually thought the Aussie might squeeze a little further. But given the fact that we only rallied to the 38% retracement, I actually need to do a little bit of drawing, because when you stop at a 38% retracement, what that sets up for is a bear flag pattern. And if we have a bear flag pattern, what could happen here is we could see a move to 70-50, which would allow for that sell-off, break to new lows, break through this support right through here, and then those of us that want to be on the long side getting long around the 70-50 level. If you listen to Gregor Horvat a couple of weeks ago, he talked about the lockdowns in Australia and how it's, and if you talk to Chris Weston at Pepperstone Securities that lives in Melbourne, Australia, talks about the draconian measures. Well, look, that are happening there. I don't believe COVID's going to affect Australia forever. And perhaps what may happen is some of the COVID lockdowns and that might maybe it loosens in the next couple of weeks. And so if we get the Aussie down towards 70 cents, 70.50, that might be a great opportunity for a counter trend, tactical long back up towards 72, 73, 74 cents. That's what I'm going to be looking for. But that means that we might see some near-term downside before we get a bounce. One other thing that I'm looking at, and by the way, I should mention this, and let me stop for a second. Let's talk a little bit about all the data that's coming out this next week. But before I say that, and before I do that, let me say, if you like these videos, give them a thumbs up, subscribe to the channel down below so you don't miss any of the great content that we put out all week. And, by giving us a thumbs up, it's kind of like a thank you for doing these videos. I appreciate that, and I know our team does too. All right, next week we have durable goods orders in the U.S. We've got retail sales in Australia early on in the week. Fed Chairman Powell, he's going to be speaking this next week. We're getting PMIs, and it will be the end or the October 1st at the end of the week. Okay, we aren't going to get jobs reports this Friday. It'll be the next Friday. But the good news is that we're going to see ISM data, the manufacturing data on Friday. We're going to get PCE, Fed's favorite inflation data, that comes in on Friday. And the reason why this is so important is because getting the ISM data on Friday of this week means that we get to get the services data next week before the jobs data, which when you have the full picture from ISM prior to the jobs data, it'll give you a better picture on what we're looking at for our jobs report not this week, but the next week. All right. One other thing that I've been looking at is the dollar Mexican peso. The dollar Mexican peso, and I was showing Helene Meisler that she comes on our F.A.C.E webinars from time to time. She writes for, I think, Market Watch, and her and I have been following each other on Twitter for many years. Nice lady who's been in the markets for, 30, 35 years, something like that. She's great. Anyway, we were talking currencies on Twitter, and we got in, I don't know why she asked and what we were talking about. I think we were talking about daily sentiment index, and I was just telling her about the Mexican peso and showing her the inverse correlation of the dollar Mexican peso and the S&P. And the point I was trying to make here is, when the S&P goes down, the dollar Mexican peso goes up. It's very similar to VIX. I mean, if you look at the dollar Mex and you just grab here. Let me remove all this stuff here. There's the dollar max, right? The blue line is the S&P, but let's go ahead and compare that to the VIX, okay? And I'm going to I'll use the CFD new price scale. Here you go. The VIX is like the dollar Mexican peso is like the VIX of the currency market. And what makes that relationship so strong is that the dollar Mexican peso has not gone down this whole year, that you've seen the stock market rally. So as the stock market has rallied, there's the S&P, what you see is the volatility and the dollar Mexican peso look very similar. So the reason why I point that out is because if the S&P does roll over, the dollar Mexican peso is probably going to rally substantially. There was a note, and one of my old colleagues that I used to trade with, he sent me a note from J.P. Morgan, how they have turned basically bearish Mexican peso, bullish dollars in this environment, and I couldn't agree more with their analysis at this point. So the reason why I wanted to bring that to your attention is because I am watching the US dollar Mexican peso very carefully. And as you can see, it's tightened up in a very, very strong range. But you know what? Banxico's rate decision is actually this week. It's on Thursday. And you know what else? The market is expecting an interest rate hike. I believe an interest rate hike is coming as well. But how about if they don't? Well then, what if the market's already expecting a hike and we're compressed the way it is? That means that if they hike, we shouldn't see us drop too much below 1980 or so in the dollar mex. But let's say they don't. The dollar Mexican peso could very easily be above 2022, which, by the way, 20.22 is a big level resistance because it is the 618 retracement of the last down move, comes in right at 2022. So guys and gals, make sure you're watching the dollar Mexican peso very carefully next week. And you know why this might happen? Because I have somewhere to be at the end of this next week. So I'm not going to be in front of the computer. And damn it, if things always happen when I'm not in front of the computer, that might go down. So guys and gals, my name is Blake Morrow. I'm so happy you spent your time with me. And I look forward to seeing you on the F.A.C.E webinar on Monday morning. Remember, it is free. So you can find the registration link at the bottom of this video. I'll see you there. And I want to wish you all a great remainder of your weekend. And I'll talk to you soon.